Hello. Today we're going to talk about interrelations between markets. Everything that we've done so far in this class, there's a new mic here. Everything we've done in this class so far, we've considered one good at a time, one product, and looked at its demand and supply and everything underlying that, the market structure. Today we're going to talk about factor markets. These are the markets for the inputs for the production. But the issues here are actually more general than that. This is the first time in which we're going to look at the interrelations between two markets. Essentially, everything in the economy is interrelated, and factor markets is a very explicit example of that. The demand for inputs is determined by people wanting to buy the output of those inputs, and so the market for the output of a good determines the demand in the market for the input. And the prices of the inputs determine the marginal cost, which then affects the price of the output. And we want to follow through this connection between the markets. Now, I can't see on the computer here, so I'm going to have to be looking up here a lot today. That's okay. So factor markets are markets for inputs. And the main concept that I want to get across today, there's going to be a lot of graphs and a lot of stuff going on. And I don't want you to get lost to, lose the forest for the trees. The idea is you want to see how the relation of the markets relate to each other, how things that happen in one market affect another market, and then that feeds back to affecting the first market. It's that interrelation that we're wanting to capture here. Okay, so the input that we're going to look at today, we're just going to call labor. It can be any input that you want, and I'm assuming here that it's a homogeneous type of labor, like programming skills. If you want to hire someone that's a programmer, there's a lot of people out there that you can hire, and there's a bunch of people who are available to be hired. You could look at this market in just a simple fashion as we've done for other goods, because it is just product, marketing skill, programming skill, and just have a demand and supply curve. So we have, we have a demand for labor. How many people, firms that are hiring programmers would want to hire at any wage rate that is charged for, that is paid to the programmers. And then we have a supply curve for labor, which is the amount of people willing to work as programmers. As the wage goes up, more people are willing to work as programmers because they'll switch from other jobs and get trained in programming in response to having the higher wage offered to them. So we have an upward sloping supply curve, just like you would expect for any good. And the downward sloping demand curve is because the more expensive it is to hire a programmer, the fewer of them are going to be hired by firms. They'll try to substitute other things instead of doing so much programming. The important thing that we need to recognize that now creates the link between the input and the output market is the fact that the demand for programmers is actually a derived demand. Firms only require programmers or labor or any input because there's a demand for the product that is produced by those inputs. So essentially, the demand for the output is what creates the demand for the input. There would be no demand for input without that. And what we want to do is follow through the full implications of this. So we want to go underneath our demand and supply curves for labor and see what this implies and how it causes a very important link between the two markets, exactly what that is. So to do this, we want to first look at how it is that a firm decides how much labor to purchase, how much inputs to purchase. And to do this, we use a concept, another marginal concept, marginal product of labor, or marginal product of input, whichever input it is. Marginal, again, it's one extra unit of labor, and product is how much output does the firm obtain from hiring one extra unit of labor. So if the firm starts out with 0 workers and increases output, number of workers in the operation to 1, could maybe have 10 units of output that is sold or produced. As it increases from 1 to 2, you could have that second worker then increases output by 9 over what was already there of 10, so that now you get a total of 19 units of output, and just continue on up. So this is the marginal product. We have, as usually with these marginals, a law of diminishing marginal product. Generally, as you get more and more workers, there's going to be some point at which additional workers quit being as useful to have as previous ones. You can think of this as my uncle's farm. You know, the first few workers he hires really increase production a lot, but then there's a point at which you really can't get that much more done with more workers. And so having extra workers will maybe help a little bit, but not a tremendous amount. At some point, it could actually be counterproductive that they get in each other's way. So you would expect that as you get more and more workers, the increase in output from one additional worker, the marginal product, will decrease. Now, this is stated as a law, again, and I think that's a bit of a misnomer. You can easily conceive of production processes where you have increasing marginal product, at least for a range of output. That would happen when workers can help each other, and 2 workers can produce more than twice as much as just 1 worker because of the synergies of working together. So, and many production processes are like that, that having each a variety of workers working together creates a synergy that increases output more than proportionately to the number of workers. So what that would mean is that you actually have an increasing marginal product of labor. However, we can actually ignore that. So this downward sloping diminishing marginal product actually just means that for the things that we care about in analyzing a market, we can always realize that there's going to be an area of diminishing marginal product. Why can we ignore it? If you've got marginal product increasing and it's say it's profitable to hire 3 workers, then it's going to be more profitable to hire 4 workers. So the decision process of the firm is pretty well set for that increasing marginal product part of the curve. If the firm ever hires 1 worker, the firm's going to continue hiring to move through that entire increasing marginal product, because it becomes ever more profitable to hire 1 extra worker. It's only when marginal product starts going down that the decision becomes, okay, now how many extra workers does the firm now hire, given that each one is a little less effective than the previous one. So the upward sloping part of marginal product is not relevant in the decision process or in the analysis of even though it exists. Eventually, all processes, you get so many workers that extra ones don't help that much more. And that's the question, how far do you go in that direction? Okay, so we want to step through exactly what the decision process of the firm is. And it's very intuitive. And then we're going to put it on graphs and show how it operates on our graphical procedure. Suppose we have that the output of this firm can be sold for $2 a unit, and that the wage rate for the programmers is $14 an hour. The question is, how many workers will the firm choose to hire? So going from 0 to 1, the product of that first worker is going to be 10. You can sell it for $2 each and get $20 of, hello? Oh, you're fixing it, great. Anyone have anything you want to talk about? Here we go. Okay, where were we? There. So the firm, by hiring this first worker, will get $20 of revenue and only have to pay the worker $14, and so get $6 of profit. So of course the firm will go ahead and buy that, purchase 1 unit of labor. And then the question becomes, will it hire a second worker? The second worker increases output by 9 units, which increases revenue by 18 units, only have to pay them 14, and so you go ahead and buy them. On the third unit, the extra revenue is 14 because the product is marginal product is 7, and you got to pay them exactly 14. Let's just say that when it's a tie, they'll go ahead and do it. In reality, it's never exactly a tie, so it doesn't really matter. But the firm will not hire, in this case, this fourth worker because the extra revenue from doing so is less than the wage rate. Profits would go down. So essentially what the firm is doing as a thought process is comparing the wage against the extra revenue the firm gets from hiring extra workers, and that extra revenue depends on the marginal product of the worker and the price of the output. In particular, this gives us what we were originally looking for, the demand for labor by the firm. I'm going to argue, and hopefully you probably already can guess, that if you graphed the marginal product of labor times price, which is that third column on the previous, here I got to hold them both here. If you graphed this amount right here, that is the demand curve for labor for the firm. Because at any wage rate, the firm will hire additional units of labor as long as the extra money they get in revenue from hiring that labor, the amount of extra output it gets by how much it can sell that output for, exceeds the wage rate. And so the firm will continue buying more and more labor until it gets to this point where the extra revenue it gets is exactly equal to how much it has to pay the laborer, and it won't go beyond that, because beyond that, the extra revenue is going to be less than the wage rate. So what this tells you is that any wage rate, you just read off of this curve, that tells you the amount of labor that the firm is going to hire. And importantly, the demand for, it's a little hard here, the demand for labor depends explicitly on the price of the output. That's going to be one of the key driving forces between the interaction. Okay, so now we know how an individual firm operates, the decision process of an individual firm. What we now want to do is to figure out what the wage rate in the economy is set at. What's the market wage rate for programmers? What I had just done is say, for an individual firm, it will compare the market rate for how much it has to pay for programmers against its revenue and decide how many to hire. But that takes the wage rate as given, which is what most firms do. I mean, no firm can unilaterally determine the wage rate for a class of workers. So what we want to do now is figure out what is the wage rate determined in the market. And we do that through a series of steps. You'll notice the similarity of this to the stuff we did for competition on output markets. It's just flipped. Everything that we did there for marginal cost adding up, now we're going to do for demand adding up. Each individual firm in the market that would be hiring programmers has a marginal product of programmers times the price of their own output, and that gives them their own demand curve for labor. You add that up over all the firms that are hiring programmers, or that would hire programmers, and you get the horizontal sum again, and that gives you the demand curve for labor in the market. I'm assuming for this analysis, and it's very easy, it's easier to think about it this way, that the number of firms is fixed, because I don't want to get into the issue of firms entering and leaving the market. So that this sum here over the firms that are in the market is a well-defined concept. It's a particular number of firms that are in the market. So you just get the demand curve in the market for programmers as the sum of the marginal product of labor for each firm times that firm's price of output. Then there's a supply of programmers, which is determined by individual people's decisions of whether to go into programming, get training, whatever. And the interaction of market demand and market supply for programmers will determine the wage rate for programmers. So we get a wage rate at that intersection and a market total quantity purchased. Then each firm in the market who is hiring programmers will take that wage rate as given, because they're all small and can't affect that wage rate themselves, and will face a supply curve for labor that is absolutely flat at that wage rate and will choose the amount of labor which that their own individual supply curve for labor intersects their own individual demand curve for labor and determines their amount of labor. Notice that this is, when we were talking about a competitive output, we had an upward sloping marginal cost curve, summed it up over firms to get the marginal supply curve, interacted that with demand, came back and we had a flat demand curve for the output. Now we've got a flat supply curve for the input. And the idea here is exactly the same. If this firm offered a lower wage than the going wage for programmers, nobody would work for them. Then get a job elsewhere. That's what equilibrium means. Every worker who wants to work at that wage gets a job. If the firm offered a higher wage, every programmer would want to work for this firm instead of all the rest of them, and this firm would experience a supply of available workers that is so high you can't even think about. So essentially this horizontal line connects those two parts, the zero and the huge quantity. The other way to think about it is the firm can get as much labor as it wants at the going wage rate. So this now determines the market for inputs. And it's very similar, just in flip, to the market for outputs. And again, notice that the price of the output good is relevant for determining the equilibrium in this market. Okay, so now what I want to do, now that we know what happens in inputs, we've already learned what happens with outputs. I want to put the two combined and show how we get an equilibrium in both markets, and then how changes in one market feed through to the other market. So all we're going to do now is think about the implications of what we've already gone through. Okay, remember this graph? This is stage one for a competitive market where the number of firms is fixed. Again, I don't want to have to deal right now with having number of firms entering and leaving. So what we have is a marginal cost curve for each firm, sum it up to get the supply curve, sum it up over the firms in the market to get the supply curve. The demand for the output gives a price, and each firm at that price realizes that its demand curve for its own product is flat at that price and chooses a quantity. So this we've already done. What we didn't make clear before, and now I want to make explicit, is that the marginal cost curve, which starts this whole analysis, remember when we drew this, we always start with the marginal cost curve of each firm, and everything else then gets added sequentially to that. So the starting point here actually depends on the price of inputs. The cost of producing an output is going to depend on how much you got to pay for your inputs. And so in particular, in the analysis we're doing today about wage rates, the marginal cost of the firm is not given. The marginal cost is actually a function of the wage rate, which means that the supply curve in the market is a function of the wage rate. So to make that explicit, we need to simply generalize our graphs from before to show that marginal cost depends on the wage rate, and then when you sum it up over all the firms, the supply curve then indirectly depends on the wage rate. Now we have an input market where the demand for the input depends explicitly on the price of the output, and an output market where the supply of the output depends explicitly on the price of the input. And equilibrium exists when both of those two markets are in equilibrium consistent with each other. And what I've just shown here is an equilibrium in the output market given a particular wage rate, and I previously showed an equilibrium in an input market given a particular price. But how do we know that the equilibrium price here is the same price that gives the equilibrium in the input market? In particular, well, here, change in input market affects the output, change in output affects the input. That should, you know that. This is what an equilibrium is going to look like in both markets simultaneously. And I'm going to talk about how to think about this and mathematically how you would do it if you're interested in the math concepts of it. Start with a given wage rate, W1. That gives a marginal cost for the firm. That gives a supply curve for the market. Interact that with the demand curve, and that gives a price for the output. And then each firm takes that price as given. Take that price, that is for the equilibrium price in the output market, and put it into the input market. Okay. And then interact price times marginal product, add that up over all the firms to get the demand curve for the market of programmers, interact that with supply, and that gives a wage rate. This wage rate, if this wage rate, W1, is the same as the wage rate you started with, then you're at equilibrium in both markets. If this wage rate is a different wage rate than what you started with, you're not in an equilibrium for both markets. So you can actually start with price instead and figure out the wage rate and then go in the opposite direction, but it's all the same. You start with a wage rate, the way I'm describing it. Start with a wage rate, calculate equilibrium price for that wage rate, then calculate, given that price, what the equilibrium wage rate is, and if that wage rate is the same as what you started with, you're in equilibrium in both markets. How many of you have taken a math class that involved fixed point theorems? No? Well, you got something to look forward to in your life. You'll enjoy these things. They're used in lots of areas, economics particularly. A fixed point of a function is when the value that you put into the function is returned by the function. So what's the fixed point of x squared? 1. You put 1 in, you get 1 out. 0 is also a fixed point. So you could think of this as a large function where you put in a wage rate, it runs through this entire functional stuff and returns a wage rate, and if the wage rate that is returned is the same as what goes in, you're at a fixed point. So an equilibrium in math terms is simply a fixed point of this simultaneous equation system. And you can prove conditions under which fixed points exist, and luckily this has been done for us. Ken Arrow and Gerard Debreu. Debreu was here at Berkeley and Ken Arrow was at Stanford, won Nobel Prize for proving the existence of these equilibria, that they do exist in a standard economy using fixed point theorems like that. Okay. So that's what you're basically doing, is you're looking for a input for one market that produces a price in the other market that then gives you back the original input price for the first market. I am not going to ask you to solve fixed point theorems on your midterm, so don't worry. I can see a little panic rising here. Okay, now given that we know what an equilibrium is, what's always useful, of course, is not just knowing what is an equilibrium, but how is there movement that moves us towards an equilibrium. So what I want to do is start out with an equilibrium and then trace through the whole set of things that happen when some exogenous event occurs. So let's start out. I wanted to put 4 graphs on one, so you have the input and output market all on one graph, but I just couldn't fit them all up there. So we're going to toggle between the input and the output market. Let's suppose that we're in the previous equilibrium where the 1 represents the original equilibrium. That's what we had in the previous 2 graphs. And what happens is, so the wage 1 is consistent with price 1. These are equilibria with respect to each other. And now suppose something happens in the output market and people want to buy more of this good. So outside of this whole equilibration process, something changed in the economy. People will now want to buy more of this good. What's it going to do? The first thing in the output market is it increases the demand for the output, which then raises the price for the output. That then will mean that each firm moves to a higher level of output, than it was originally. But this analysis gives you how much the firm would increase its output if the wage rate stayed at W1, the same wage rate as it did before. But now the price of the output is higher. And we know that the wage rate, equilibrium wage rate, depends on the price of the output. So we want to trace that through. The first effect is the price of the output rises to a new equilibrium. Then, now each firm faces a new demand curve. Each firm experiences a new demand curve for the input, labor, because the wage rate is higher. So now we've got marginal product times the original price. We move the demand curve up to represent the increase in the price. Essentially, now that the price of the good is higher, the value of hiring workers goes up. Each worker's product is more valuable, and that's going to play through in the input market. So what happens here is each firm's demand curve for labor increases. That then increases the market demand for labor, which then increases the wage rate. Okay. But what happens next? We know that as soon as you change the wage rate, the marginal cost of the firm is going to change. This is the marginal cost of the original wage rate. Now that the wage rate is higher, the marginal cost is going to be higher. So the marginal cost curve goes up, and this means the supply curve in the market, which is the sum of these, moves up, and this leads to a further price increase. So actually price goes up further than you would think if you only looked at the output market. If you were looking only at output markets, ignoring what was going on in the input market, you would think price is going to rise from here to here, and that would be it. But you have a feedback loop going on that's a kind of self-reinforcing feedback loop. The higher price leads to a higher demand for labor, which leads to a higher wage rate, which leads to higher cost for producing this good, which shifts into the supply curve and leads to a higher price. This higher price then, once again, leads to a higher demand for labor, and the process continues, getting ever higher. Well, you should be asking yourself, does this ever stop? And the answer is, yes, it does. So here's again with the new price for labor, increases the demand for labor to a third thing. It moves to a new equilibrium. And simply the existence of an equilibrium at any given preferences by customers was what the Arrow-Debreu results were about. So you can take as given that there will be an equilibrium, it'll move to a new one. The last graph that I want to show, though, is that you can say a little bit about where this equilibrium is going to be. You can obviously solve it simultaneous equations if you like algebra. But even just looking at the graphs, you can have a concept of where the new equilibrium is going to be, at least within a range. And this concept is actually useful for understanding how the whole process operates. So I've drawn kind of all the stuff in the previous graphs on these two. We start out here with this demand, and we start out here. Those are our two equilibrium for the input and output markets. The demand for output increases. And the first thing to recognize is if that is all that happened, that there was no feedback in the input market, then output would increase from this vertical line to that vertical line. So it would have that much increase in output. And if somehow wage remained constant, it's impossible for it to do it, but if it somehow did, this is a useful thought process, then the amount of labor that each firm would want to hire, or that would be hired, that the demand for labor in the market would rise from here to the new demand curve, which is based on the new price of the good. So labor would increase from here to here. If somehow, it won't happen, but if price, wage rate remain constant. In a sense, these are the outer limits of what the new equilibrium is going to be. After that, after all these, everything else moves back a little bit, kind of attenuates the effect that the original move had. Here, you increase the price, But then the increased price leads to higher wages, and so you get a higher supply curve, and output drops a little bit. And similarly, then again, with that higher price, it leads to higher wages and a slight attenuation in output again. So you originally go to this point and then keep moving back for every ripple that occurs. Obviously, it might not be obvious, but you can't go past this point where you started. It's not possible that a higher demand for the good will lead to less of it being produced. So the new equilibrium is going to be somewhere between these two vertical lines. And how far it is depends on how much of that interaction, how powerful it is. Similarly, in this market, if price didn't change, if the wage rate didn't change, you'd move to here. But what that does in this market is create excess demand, which equilibrates at a new price and at a higher wage rate, which is an attenuation of the increase in demand. So the amount hired wouldn't move to here because you can't hire that many. It won't be, that supply isn't available. Price rises, and as the wage rate rises, the demand for the laborers will decrease and move to here. And then price goes up again, you get the same process. So here you will also end up between the two vertical lines, and you can't go in either direction past them because, again, an increase in the product, in the demand for the good can't decrease the quantity of inputs that are used in producing the good. Yeah. This is, yes, this would go, I'm not sure what the inputs would be, but suppose something happens and we all want to drive a lot. And so the demand for gasoline rises. There's a shortage of gasoline, and the price of gasoline then rises to meet that shortage. This happens on holidays occasionally, though forget that statement. This would have to be a long-term thing. The increase in the price of gasoline will then increase the demand for oil, which is used to produce gasoline, and you get a higher price of oil, which then causes an increase in the price of gasoline. It's a positive feedback. It feeds on itself. It's interesting, most processes that happen in economics operate in opposing directions. You get an increase in price and then something that causes the price to decrease and da-da-da, you know. Here, all you're getting is increases in prices. And the question is, how far do those increases in prices continue until you reach your new equilibrium? Anything else? Neat stuff. Okay, see y'all on Monday.